Hi folks, David Raring here again with InformedTrades.com and today's lesson of the day. In our last lesson, we began our discussion of the Japanese yen with a look at the history of the Japanese economy as well as the lead up to what became one of the biggest asset price bubbles in history. In today's lesson, we're going to continue this discussion with a look at what happened from the early 1990s on from an economic and monetary policy standpoint so we can understand the fundamental foundation upon which the yen sits today. So let's get started.
In 1989, the Bank of Japan began to raise interest rates, and the government instituted limits on total bank lending to the real estate sector. They did this to try and rein in speculation, which was driving stock and real estate prices to astronomically high levels. While the central bank was hoping to simply take the foot off the gas and tap the brakes on the economy, unfortunately, the market's reaction was drastic, resulting in a stock and real estate price crash starting in 1990. This was a perfect storm, so to speak, for the Japanese financial system and economy, as the effects of the decline in real estate and stock market prices started a chain reaction which reverberated throughout the economy and whole financial system. The first and perhaps most important thing to understand here is that the economic slowdown, combined with the drastic falls in stock and real estate markets, caused the financial position of Japanese banks, which were at the center of the financial system, to rapidly deteriorate. Much of the speculation that was sending real estate prices so high was being driven by loans from Japanese banks, which took the land they were making the loan on as collateral. As the quality of the loan was thus tied to the value of the real estate backing that loan, as real estate prices fell off a cliff, so did the quality of the bank's loan portfolios. Secondly, large Japanese institutions such as banks cooperate with one another, and as a result of this, Japanese banks hold large quantities of each other's stock. Holdings of stock are considered an asset for the banks and were included in their capital numbers, which basically define how financially solid a bank's balance sheet is. As the value of these stock holdings tumbled lower with the rest of the market, so did the bank's capital position, putting further pressure on the stability of the individual banks in Japan and the Japanese banking system as a whole. Thirdly, as the economy slowed as a result of all this, the individuals and corporations who had received loans from the banks began to have a harder time making their payments, further deteriorating the quality of the bank's loans and the stability of the banking system as a whole. At least partially as a result of weak corporate governance, most will argue that Japanese banks did little to adjust to the new financial difficulties they now faced, instead preferring to sit on their hands and wait for stock and real estate prices to move back towards their pre-bubble bursting levels. The government also did little to address the problem until 1995, when it became clear that without government intervention, massive bank failures would result. This history is important to us as traders for two reasons. Number one is that reforms aimed at returning the stability of the Japanese financial system are still ongoing today, and it is these financial and structural reforms that traders watch closely when trying to determine the long-term fundamental direction of the Japanese economy. Number two is that Japanese consumers, many of whom lost large sums of money in the real estate and stock markets, lowered consumer spending significantly during this time, resulting in prices actually starting to decrease toward the end of the 1990s, something which is known as deflation. While many argue that the Bank of Japan acted too late, they did eventually respond to the economic weaknesses with interest rate cuts, driving interest rates in Japan down from over 8% in 1990 all the way to 0% in 1999. While they have increased interest rates in Japan to 0.5% since then, this is still by far the lowest rate of any of the major economies of the world. As a result of this, it is very cheap to borrow Japanese yen, making it the primary funding currency for carry trades, which we learned about in Module 3 of this course. One cannot fully understand and anticipate movements in the Japanese yen without a full understanding of the carry trade. So if you haven't done so already, I encourage you to go back and review the 3-lesson series in Module 3 that we did on the carry trade. That's our lesson for today. In tomorrow's lesson, we will wrap up our lesson on the yen with a look at the history of Bank of Japan interventions in the currency market and the major economic indicators which move the currency. As always, if you have any questions or comments, please feel free to leave them in the comments section below. And good luck with your trading.